I want to show you something that took me a long time to see clearly, because it hides in plain sight inside almost every losing trade you'll ever take. It's not a bad entry. It's not a bad setup. It's something that happens after you're already in the trade, and once you see it, you won't be able to unsee it in your own history. My name's Tom. I've spent time around trading communities, watching how struggling traders actually behave once they're in a live position, not just what they say their plan was beforehand. What I want to walk you through today is a pattern I've pieced together from that, a composite built from the kinds of trades I've seen over and over. From different people, different instruments, different account sizes, all converging on the exact same underlying mechanism. I'm not going to pretend this is a formal academic study. It's not. It's a pattern, and I think once you see it laid out, you'll recognize it immediately in your own trading, because I'd bet almost everyone watching this has lived some version of it already. Here's what you'd expect this pattern to be, because it's what most trading content tells you to expect. Bad entries. Chasing moves, ignoring clear resistance, taking setups against the trend for no good reason. That story isn't wrong exactly, it's just incomplete in a way that matters more than people realize. And it's not actually the pattern I want to show you today. Here's the transition that changed how I think about this entirely. In the losing trades I've broken down and discussed with traders directly, the majority had a technically sound entry. The setup was real. The reasoning behind getting in was defensible, sometimes genuinely good. Looked at only at the entry point, most of these trades would get called well executed. The losses didn't come from bad analysis at all. They came from somewhere else entirely, somewhere that almost nobody in this space points a camera at, because it's less satisfying to talk about than, here's the setup you should be looking for. Before I go further, I want to be upfront about how I'm putting this together, because I don't want this to sound like a peer-reviewed study when it isn't. What I'm describing comes from watching real trading behavior over time, conversations with traders about specific losses, and the kind of patterns that show up consistently enough that they stop looking like coincidence. Where I use numbers or specific trade examples below, treat them as illustrative composites built to make an abstract pattern concrete, not as a verified data set. The pattern itself is the real finding. The specific numbers are a teaching device for showing you how it tends to break down. That distinction matters because it's what let me separate three specific flavors of the same underlying mechanism, rather than lumping everything into a vague emotions get in the way explanation. The pattern was this. Something happens after the entry inside the life of the trade itself that had nothing to do with the original plan. I call it the modification moment because, in case after case, there's an identifiable point where the trader changes something about the plan they'd already made, mid-trade, based on how the position was making them feel in that moment, rather than any new information about the market. Let me walk you through what this actually looks like, because modification moment sounds abstract until you see it inside a real trade. Picture a trader I'll call Marcus. A composite built from a pattern I've seen play out again and again. He enters a short position with a clearly defined stop placed above a recent swing high, the kind of stop level you'd defend in front of anyone. 15 minutes into the trade, price rallies close to that stop without actually touching it, then pulls back. Marcus, watching this happen in real time, moves his stop tighter, closer to his entry, telling himself it's just to protect the trade. Price rallies again 10 minutes later, hits the new tighter stop, and stops him out for a loss. The original stop, the one he'd planned before he had money in the trade, never got touched at all. 20 minutes after his exit, price reverses hard in the direction he'd originally predicted, exactly the way his original plan expected it to. That trade wasn't a bad entry. It was a good entry that got modified out of existence by a decision made under the emotional pressure of watching price move close to a level that scared him, even though that level never actually got hit. Here's another composite. A trader I'll call Rachel. She enters long on a pullback setup, again with a defined stop and a defined target. The trade moves in her favor almost immediately, up about 60% of the way to her target within the first 20 minutes. At that point, watching an unrealized profit that feels good sitting in front of her, She closes the position early, well short of her actual target, telling herself she doesn't want to give the gains back. Price continues in her direction for another 2 hours, comfortably exceeding her original target with room to spare. Now, this one's interesting because it's not technically a loss in the traditional sense. She closed green, but measured against her own stated plan and her own risk taken to enter that trade, the math on that specific decision was firmly negative relative to what the trade was actually worth by her own rules. It's worth including anyway, because it's the exact same mechanism as Marcus's loss, just wearing a different outfit. A plan, abandoned mid-trade, based on an emotional reaction to unrealized outcome rather than any actual change in the setup. Here's the uncomfortable pattern underneath both of these, and honestly underneath most modified trades I've come across. The modification tends to happen at a specific type of moment. Watching an open position do something the trader didn't expect, moment to moment, in real time, not before the trade, not after the trade, in a calm review. During it, while money is actively at risk and price is actively moving. This tells you something important about where the actual problem lives, and it's not where most trading education points its cameras. The problem isn't in your pre-trade analysis. In case after case, the analysis was fine. The problem is in what I'd call the live window, the specific stretch of time between entering a position and exiting it, where a plan made by a calm version of you gets handed off to a version of you that's now watching real, moving numbers attached to real risk. I want to be specific about why this live window is so dangerous, because there's an actual mechanism here, not just a vague description of emotions. When you build a trading plan beforehand, you're doing so without any live feedback. No number is moving, nothing is confirming or threatening you in real time. Your decision-making in that moment is structurally calm and abstract. The moment you're inside a live trade, you get a constant stream of feedback, price ticking up and down, your unrealized profit or loss updating in real time, and that stream of feedback recruits an entirely different part of how you process decisions. You stop reasoning from your plan and start reacting to the feed. This is worth sitting with, because it explains something that confused me at the start of this study. These weren't undisciplined traders. Several of them had genuinely solid written rules they could recite accurately if you asked them cold, outside of a trade. The rules weren't the problem. The problem was that the rules were being authored by one version of the trader and overridden live by a different version of the same person, one operating under a completely different set of inputs. I want to break down the modification moments I found into 3 specific flavors, because they weren't all identical, even though they shared the same underlying mechanism. The first flavor, and the most common, one in my 50 trades, I'll call premature protection. This is Marcus's trade. The stop never gets hit, but the trader tightens it anyway in response to price getting close. And the tighter stop then gets hit by ordinary market noise that the original wider stop was specifically placed to survive. This showed up in 19 of the 34 modified trades. 19 out of 50 total losing trades. In a study of 4 different traders, came down to this single specific behavior. A stop placed correctly beforehand, then tightened defensively in real time, then hit by exactly the kind of noise the original stop was built to tolerate. The second flavor I'll call premature harvest. And that's Rachel's trade. The position is working, moving favorably, and the trader exits early, specifically to lock in a gain that feels good in the moment, well short of where their own plan said the trade was actually going. This showed up in 9 of the 34. Less common than premature protection, but showing up often enough that it's clearly not a fluke specific to one person's psychology. The third flavor, the rarest but in some ways the most damaging, I'll call size escalation. This is where a trader, mid-trade, adds to a losing position that's moving against them, based on a live, in-the-moment belief that the move is about to reverse any second now. This showed up in 6 of the 34, but those 6 trades accounted for a disproportionate share of the total losses in the entire study. Because adding size to a losing position mid-trade doesn't just repeat the original mistake. it multiplies it. Trade 41, one of these six, belonged to a trader I'll call James. He entered short, price moved against him by roughly half of his planned stop distance. And rather than accepting the trade might simply be wrong, he doubled his position size at that point, reasoning, in his own words at the time, that the extra size would average in a better price once the reversal came. The reversal did eventually come. 4 hours later, well after his original stop level, would have taken him out at a small, defined, survivable loss. Because he doubled size at the worst possible point in the trade, his actual loss on that single position was larger than his 3 previous winning trades combined. One modification moment on one trade erased what had otherwise been a genuinely solid week. In my experience, most modified trades fit cleanly into one of these 3 categories, which tells me this isn't hundreds of different personal failings. It's one mechanism, wearing 3 different outfits, showing up across very different people, trading very different approaches. So here's the actual pattern, stated plainly. The plan isn't usually the problem. The handoff is the problem. Specifically, the handoff between the calm, abstract version of you that builds a trading plan and the live, reactive version of you that watches a real position and improvises against that plan in real time. A huge share of avoidable loss traces back to that exact handoff going wrong, not to the plan itself being flawed. This matters because it completely changes where you should be spending your effort if you want to actually fix this. Most struggling traders spend nearly all their improvement energy on the planning stage, refining entries, tweaking indicators, reading more books about setups. This pattern suggests that energy is being spent in the wrong place entirely. The plans, by and large, are fine. What needs fixing is never touched by any of that effort, because it lives inside the live window, a stretch of time most trading education doesn't even acknowledge as a distinct phase with its own separate risks. Here's another way to think about why the live window works this way, if the mechanism itself still feels a little abstract. Your calm, pre-trade brain and your live, in-position brain aren't really running the same software. One is doing slow, deliberate reasoning, weighing probabilities, comparing setups against criteria you wrote down with a clear head. The other is running on a much older, faster system, the same one that reacts to a sudden loud noise or a near miss in traffic, built for split-second physical survival, not for patiently sitting with an uncomfortable, uncertain outcome for 20 more minutes. A live position with real money attached produces exactly the kind of physiological signal that older system is built to react to. It doesn't know the difference between prices near my stop and there's a genuine threat right in front of me. It just knows something uncomfortable is happening, and it wants that discomfort resolved immediately, one way or another. That's a perfectly reasonable system to have if you're avoiding a predator. It's a terrible system to have making decisions about a stop loss. That distinction, more than anything else, is why just be more disciplined fails as advice here. You're not asking someone to be more disciplined. You're asking one system in their brain to override a different, faster, older system that was never designed to lose gracefully to patience. It can be done, but not by willpower alone, which is exactly why the fixes below lean so heavily on removing the decision from that moment entirely, rather than trying to out-discipline it in real time. Let's talk about what actually addresses each of these 3 flavors, because generic advice like trust your plan doesn't survive contact with an actual live trade, the same way it rarely survives contact with a real one. For premature protection, the fix has to happen before the trade, not during it. Write your stop level down somewhere you can't quietly edit in the heat of the moment, and treat any adjustment to it during the life of the trade as requiring a specific written reason tied to new information about the market, not a reason tied to how close price got to that level. Price is near my stop is not new information. Your stop already accounted for exactly that possibility when you placed it. If nothing about the setup itself has changed, the stop doesn't move. Full stop. No exceptions for how uncomfortable the proximity feels in the moment. For premature harvest, the fix is almost mechanical rather than psychological, and that's deliberate, because in the moment willpower is precisely the thing that fails here. Where possible, use a limit order at your actual target, place the moment you enter the trade, so that harvesting the position early requires actively canceling a working order rather than passively letting a plan lapse. This flips the default. Instead of needing discipline to hold to your target, you need active effort to abandon it, and that small structural flip changes outcomes far more than people expect. For size escalation, the fix is a hard rule with 0 live exceptions. No additions to a losing position. Ever. Under any circumstance. Full stop. Not usually don't, not only if conviction is very high. Almost every version of this behavior I've come across involved a trader who described feeling unusually certain the move was about to reverse. That feeling of unusual certainty, live, inside a losing position, is precisely the signal to walk away from the keyboard, not the signal to add size. It's the single most dangerous feeling in the entire live window, because it feels like insight and functions like gasoline. Notice something these 3 fixes have in common. None of them are about becoming more disciplined in the abstract. They're about removing the decision from the live window entirely, wherever possible, and handing it back to the calm version of you that built the plan in the first place. That's the real shift underneath all of this. You're not trying to become someone who resists temptation better while staring at a moving chart. You're trying to build a process where, as much as possible, there's nothing left for the live version of you to decide at all. This is where this pattern actually changes how I think about trading psychology as a whole. The dominant story in this space is that you need to master your emotions in the moment. Stay calm, breathe, trust the process while the trade is live and the numbers are moving. What I keep seeing suggests that framing is backwards. You don't need to get better at staying calm during the live window. You need to get better at not needing to make any decisions during it in the first place. The traders who lose the least, even when they do lose, aren't the ones who seem calmest. They're the ones whose plans leave the least room for a live decision to even occur. Here's the identity version of that shift. Stop thinking of yourself as someone who needs to execute your plan well under pressure. Start thinking of yourself as someone whose job is to design plans that require nothing of the version of you that's under pressure at all. Those are 2 completely different skill sets, and almost the entire trading education industry teaches the first one, when the second one is what actually shows up, over and over in the losing trades I keep coming across. I'll be honest about what this looks like day to day, because it's not glamorous. It looks like writing your stop and target down before you enter, setting a limit order at that target the second you're filled, and then, if at all possible, not watching the trade tick by tick while it's live. Traders describe, almost sheepishly, watching their open position for the entire duration of the trade, every tick, the whole time, right up until the moment they modify the plan. It's rare to hear about this happening to someone who'd stepped away and come back later. That's not a coincidence, and it's probably the single most actionable insight in this whole pattern. The live window is dangerous, specifically because it's watched, tick by tick, by the version of you least equipped to be making decisions in that moment. So, if there's one boring, unglamorous habit worth taking from this, it's this. Once your plan is set and your orders are placed, get away from the live chart. Not out of avoidance, out of respect for the fact that the version of you watching that chart in real time authored 0 of your actual edge, and given the chance, mid-trade will happily override it. Picture Marcus making one change going forward. He places his stop and target as actual orders at entry and closes the chart until one of them fills. Rachel does the same. Neither treats this as some dramatic psychological transformation. Both would probably describe it as almost boringly simple, and it's exactly the kind of change that tends to move the needle more than anything learned from studying setups and entries. That's the pattern. Not bad analysis. Not a lack of good setups. A live version of you, watching a moving number, quietly overriding a plan that a calmer version of you got right in the first place. Fix the handoff, and you'll likely find a lot of your own losses were never actually losses waiting to happen. They were good trades, sitting one modification moment away from working exactly as planned. If you take one thing away from this, let it be the exercise as much as the finding. Go back through your own last 10 or 15 losing trades, not with a fresh eye toward whether the entry was good, but with a specific question. Did I change anything about this plan while it was live, And if so, what was I feeling exactly in the minute before I made that change? Most of you won't need many trades to see it. I'd bet it shows up in the first 5.